Okay, good morning and happy Tuesday. Welcome back to our Tuesday morning market outlook session. My name is Tony Zhang. I'm the chief strategist here at OptionsPlay, and we are at a pretty pivotal moment here in the broader markets going into the election. So really important in terms of giving you guys an update as far as where we currently stand for both equities as well as fixed income. So let's go ahead and get started. Before I do, what we're going to discuss here today is purely for education and demonstration purposes. It is not a solicitation or recommendation to buy or sell any specific securities. So today, what we're going to do is we're going to spend a bit of time looking at the broader market indices. Most of the major indices are at a very pivotal moment. So it's important to understand where we currently stand, what our outlook is currently for those markets, and how we are likely going to trade that particular outlook. We'll take a look at volatility as well, which provides us some clues as to the directional view of the markets. And then we'll take a look at how commodities and rates have responded as well. Our rates have seen a significant uptick over the past couple of weeks in terms of longer duration bonds, moves in TLT, what that means for the broader markets, what opportunities we currently see in the rates market, and then taking a look at both economics and the current statistics for the outcomes for the election. And lastly, we're going to share with you some of our ideas before, if we have a few minutes, we'll open this up for Q&A. But the primary question that I want to help investors answer right now is the fact that we saw a breakout here a couple of weeks ago above some major resistance levels that we've been talking about for quite some time, pretty much since the beginning of September. The fact that we broke out above those levels and now the market has kind of fizzled out a little in terms of momentum, in terms of the rally, the news on the stimulus hopes have started to recede, and the markets have fizzled out, if you will. And the question is really, is this the end of this rally or is there more to come? That's the primary question that I think is on many investors' minds, and we want to try to answer that question. So my name is Tony Zhang. I'm the chief strategist here at OptionsPlay, and I want to spend a little bit of time here to make sure that everyone understands my charts, the economic research that I'm currently looking at, to help you inform your decisions here in the broader markets. So let's go ahead and get started. We'll first start off with the NASDAQ 100 index, the QQQ. We've been talking about 282 for quite some time, ever since the initial September plunge as a major resistance level. We broke out above that level a couple of weeks ago, and now we're coming back to retest that level as support. Now, both post-market and pre-market to this morning, the markets have held that level. So currently, early signs indicate that it is holding, and we're likely going to see a bounce off of that. But this is one that's important to pay attention to, because there is a bit of distribution here in the broader markets. And it's possible that we see a break below these support levels. A break below these support levels means that we are likely to revisit perhaps that 260 low here to the downside. Now, I will say a lot of this breakout here was on stimulus hopes. So it wouldn't be surprising if over the next couple of days, we find out that we're not going to see a stimulus before the election, which means that we're less likely to see a stimulus before the end of the year, that is what drives markets back towards these 260 lows. I think that's very possible. So I think it's important for us over the next couple of days to really pay attention to the news and what is likely going to happen here in terms of how markets respond to this major support level. We see the exact same level here on the SPY, 343 on SPY. Breakout from 343, came back to now retest this as support, and the question is whether we're going to bounce off that level or break down below this level. Again, I think it's more likely that it's going to be news driven that generates the catalyst that either holds the support level or breaks below that support level, but important to pay attention to, because that's going to inform whether over the next couple of weeks going into the election, we're looking for more weakness or we're looking for a little bit more strength as these levels hold as support. So we're seeing this not only on the NASDAQ, the SPY, but we're also seeing it on IWM, small caps. We've been talking about 160 for quite some time here for small caps. Small caps has been responding to this 160 level for multiple years. And the fact that we managed to break out above that level a couple of weeks ago was very, especially after such a strong move to the upside, was surprising to us. So now we're back to just 160 as support, and the question is whether that can hold. Previous attempts above 160 did not last very long, and it fell apart here. Most attempts above 160 have not been very long here on IWM. So the question is whether or not we're going to see the same reversal here for IWM as we did for the other major markets. So out of the three major markets, we're seeing them all respond very similarly to major support levels so far. And lastly, RSP, the equal weight S&P 500 index, also responding to this roughly 112 level here as a support level that has been holding for quite some time or over the past couple of weeks. 112 has been a major level or line in the sand, and the question is whether 112 will hold here for RSP. So that's how we're viewing the major broader market indices. Like I said, major pivotal moment. Make sure that you take a look at how the markets respond here over the next couple of days to those levels. Now, when we look at GLD, GLD is one that's still barely hanging on to 180 as a support or resistance level. It is trading itself into a bit of a triangle here below 180. Now, the fact that we're seeing higher lows to the on the GLD leads me to believe that it's more likely that we see this move here to the upside. But again, this is likely what's going to be driven more on stimulus rather than anything else here from GLD's perspective. So if we do see a big amount of stimulus that is likely going to drive inflation expectations, that is the type of catalyst that we would like to see for gold to continue to rally higher. We currently have a long gold position, or rather a neutral position here in GLD by selling put credit spreads here. This is one that we are watching very closely because of the fact that we have a position here in GLD. When we look at volatility, volatility remains very elevated. There's no doubt about it. The VXN that tracks an the NASDAQ 100 volatility index, currently trading at 36%, very, very high, meaning there's still a lot of anxiety from investors going into the election, expecting that there's going to be a fair amount of volatility coming out of the election outcome. We'll talk a little bit about that in terms of where the current election sits in terms of statistics and how we see the different outcomes potentially moving the markets here. So volatility remains high. Now, if you're going to be selling premium because volatility is high, I do think that focusing on some of the sectors that are less likely to have a big sway as a result of the election outcome is really one that you want to pay attention to, such as technology. Technology is largely going to be, roughly the same regardless of the outcome of the election in terms of how the markets are likely going to view the technology sectors. So selling volatility in those type of sectors may yield better results than selling volatility in certain industries that are going to be much more widely debated in terms of how they're going to perform based on the outcome of the election, such as in defense. Defense sectors, generally speaking, are likely going to see better results out of a Republican government than they are out of a Democratic government. So that's just an example of how to think about viewing selling volatility going into the election, because high volatility certainly gives you a better environment to sell, but it also comes at a higher risk. And we want to make sure that we're able to sell elevated premium, but do so in a way with sectors that perhaps have lower risk to the outcome of the election or less sensitive to the outcome of the election. So pay attention to that. Now, when we look at this very important indicator that we've been looking at for quite some time, is the VIX 3-month or the 3-month VIX divided by the front month VIX. And we're seeing it just hovering above this one level. Now, one, generally speaking, has been a level to buy, as we saw here in the September 4th or September 5th lows. That was an opportunity to buy. We're here back at that same level. This could be another buying opportunity, which coincides well with the support levels that we're referring to. However, this is also a time where we could potentially see a breakdown below one, which is generally speaking more of a sell indicator in the broader markets. So both the markets from an absolute level and volatility showing us we're both at a pivotal moment. So this is, again, why we really want to pay attention here over the next couple of weeks. And the next couple of days. And what do we want to pay attention to specifically over the next couple of days? And from my perspective, that really comes down to stimulus and potential any shifts that we may see in the trends going into the election from polls. So we haven't seen the polls move very much here over the past week or so. We have seen some movement, and I'll show you what those are, but the movements, in my opinion, are fairly small or fairly insignificant. But those are the two things that I think could be the catalyst that either drives markets to hold these major support levels or break down below these support levels. And we can use these VIX indicators to confirm any type of movements that we see coming out of the equity market. So if we see equity markets bounce and we see these volatility indices bounce as well, that's confirmation that those levels are going to hold. If we see a break below those levels and we start to see volatility break below 1, that's also a confirmation that we are likely going to see a continuation lower here. So very, very important indicators, in my opinion, to pay attention to. Now, on the HYG front, the high yield bond front, we've started to see some outflows here over the past couple of weeks as it failed to break above this triple top at 85 and a half here. And HYG, if you look at the fixed income spectrum, high yield and investment grade are the two best performing groups within the fixed income sector. If we look at government bonds, long duration, short duration bonds, those are some of the worst performing groups within the fixed income space. So we're starting to see outflows out of the HYG, so a little outflow out of the riskier products, but we're also seeing outflows from the government bonds as well. So this is one that I also think is worth paying attention to, because if HYG breaks below 84, that certainly speaks to more of this flight out of fixed incomes. And this speaks more to, in my opinion, to the recent uptick that we've seen in interest rates. So if you look at the 10-year, is now just shy of the 80 basis points here. If we see a breakout above 80 basis points on the 10-year, that I think is going to have some ramifications for fixed income, both on the high yield as well as TLT, the government bonds, because we've seen TLT trend lower here over the past couple of months here. Since pretty much the mid-August, as you can see, TLT has been trending lower, and it's just now coming to test the 200-day moving average. You saw the test of the 200-day moving average a couple of weeks ago, so the test of the 200 moving average yesterday, and the question is whether this 200-day moving average is going to hold, because if we do see a breakdown below the 200-day moving average, that's where there is a significant downside here long term for TLT. So this has some major ramifications. We took, I had a long position going into TLT off of that bounce of that 200-day moving average. We're now back to the 200-day moving average. So this is one that I'm paying attention to very closely, because a break below that 200-day moving average, it would be a significant move, in my opinion, here for fixed income, and could potentially put this rally, this very long-term rally we've seen in bonds, into question, or into potentially a reversal here for this long-term rally we've seen in government bonds, which also will lead likely to some declines here in high yield and investment grade bonds as well. So very pivotal moment, not only for equities, but also for fixed income as well. Now, when we look at the economic picture, this is really where we continue to see certain areas of the market surprise us to the upside. Now, consumer spending has been fairly strong off of the rebound that we've seen from the March lows. Now, retail sales started to slow down over the past couple of months, but we started to see more surprise to the upside. This is one that continues to surprise us to the upside. Retail sales, a survey with a growth of 0.3%, came out a growth of 1.4%, which is the largest jump on record we've seen since 1993, or pretty much right before the dot-com boom was the last time we saw these types of numbers here. So retail sales looking extremely strong. And especially if you look at, going into the holiday season, this is one that not only do we see retail sales being relatively strong from an online perspective that we know has been a huge driver of the gains that we've seen on retail sales, but we're also seeing department stores surprise us to the upside here. So we saw a significant uptick in department store retail sales. So, names like Macy's, Nordstrom's, these are names that have been beat up pretty heavily here over the past few months that seemingly have found a bottom, and perhaps this is the data that we were looking for a potential uptick for some of these names. And you combine that with the online retail sales that has been, as you can see, at multi-year highs, despite the fact that we've had this coronavirus pandemic, as you can see, well above the past 8 years or so in terms of spending. And as you can see at the end of the year, there's always this acceleration due to the holidays. And the question is really whether or not this year we're going to see that same acceleration. My guess is that that acceleration is going to slow down compared to previous years going into the end of the year, just because unemployment's going to run out especially if there's no additional stimulus before the end of the year. That's going to be, in my opinion, be a little softer in November and December, but we do expect October to be fairly strong because we've seen a shift from Amazon Prime to move their Prime Day from July to October. So October is likely going to be another strong month, which could be, again, the catalyst that the markets need to regain these major support levels that it's currently holding and to continue its moves higher beyond that. Retail sales or consumer spending as a whole is a primary driver of gains that we're currently seeing in the broader equity markets. When we look at COVID-19 numbers, this is really where, if you look at the headlines, there continues to be a rising number of cases. Europe is looking surprisingly terrible on this particular front. But if you look at the number of cases that we've seen here in the US, that uptick that we've seen recently, what you notice is that most of that uptick, if not all of that uptick, has come from rural areas. So when you hear about concerns about a lockdown, you hear about concerns that we're going to have to reverse these, and we're starting to see a little bit of interest from some of the stocks that are locked down stocks like Clorox, Procter and Gamble. This is really where I don't buy that very much because of the fact that we see almost all of these rising cases coming from rural areas. Rural areas are unlikely to go into lockdown, or even if they do, they're less likely to have a large impact on the overall economy. It's really when major cities get locked down that you have major disruptions to the economy. We're just simply not seeing the rise of cases from major cities, so we don't see a real a catalyst for these cities to shut down and potentially go back into lockdown, and that would reverse the shape of the current recovery that we're seeing. So that is not really a concern for us going into the election or going into the end of the year of more lockdowns, even though we keep hearing about reports of that or concerns about that from investors. This is one that we don't particularly think is a big concern. However, when we look at some of the economic numbers, consumer spending consistently surprises to the upside. Employment numbers continue to surprise to the upside. Granted that employment numbers, in my opinion, don't mean a whole lot in terms of unemployment rate. I think the number of jobs that are added are far more important. But if we look at manufacturing and look at industrial demand or industrial production, these were numbers that were leading the recovery. We started to see this slip a little bit over the past couple of months here. Industrial production actually going negative now, going into contraction territory of 0.6%. We're also seeing manufacturing numbers come out to be fairly soft here to the downside. So this is really where we have to, use these numbers to gauge the shape of the recovery. And I think if we look at these numbers, it's pretty clear that it's not going to be a straight V-shaped recovery. It's more likely going to be some of the other letters, perhaps of a W-shaped recovery or an L-shaped recovery. These are the types of shapes that we're starting to see play out from some of these industrial and manufacturing numbers, which are very important aspects to our recovery as well. But again, retail sales or consumer spending is definitely going to be the primary driver. And I think speaks to, for a lot of investors that are asking, how can equity markets be at all-time highs? It really comes down to the strength of the US consumer and our ability to continue consuming and buying products. That really is why equity markets are where they currently are. And lastly, to look at some of the election numbers so far. So far, not much has changed here. The polling for Biden versus Trump has pretty much been steady over the past week or so. Slight move in favor of Trump, but that could be due to polling error. So the change, in my opinion, is not significant enough to change our reviews in terms of what the potential outcomes of the election are going to be. If we look at the stats, this is really where we have seen some movement in terms of decline in terms of the probability of a Democratic sweep, an increase in the probability of a Republican sweep. Still, the two numbers are worlds apart. So in my opinion, even though this is really where we've seen the biggest movement, it is not necessarily significant in terms of any changes in our outlook. And we've seen a slightly lower move actually here in the outcome of a Democratic House and a Republican Senate here. So those are the numbers. Again, we haven't seen much movement here over the past week, but over the past 4 weeks, it is continuing to trend in the favor of Biden victory and a Democratic sweep here. So that is still by far the two strongest from a polling perspective. But as we learned in 2016, polls don't necessarily dictate what the outcomes are going to be. But the polls here have been fairly consistent and have been fairly strong in favor of this particular outcome compared to what we saw in 2016. So with that, let's take a look at some of the ideas that we're currently paying attention to. Now, for those of you that caught CNBC on Friday afternoon for options action, you saw that you saw me make a case here for Snapchat, and I see the same potential outcome here for a name like Pinterest, which also reports earnings relatively soon. And it comes down to the fact that social media use continues to rise, and you have these and you have certain platforms right now that have seen a significant explosion in terms of downloads. So Pinterest is at the forefront of this. Pinterest is obviously the lesser known of all of the social medias, or the smaller of the major social media platforms. But has seen some very strong engagement numbers. We've started to see revenue numbers look very strong. And then you couple that with the strong downloads number, this speaks to the strength of Pinterest, the same way we've seen the strength here out of Snapchat. So Pinterest is one that I'm also have on my radar. If you missed out on the Snapchat trade, or if you're looking for an alternative, you don't like Snapchat, Pinterest is, in my opinion, another alternative that you can see that has the same underlying thesis as the Snapchat trade that I highlighted last Friday here on CNBC's Options Action. On the flip side, I want to take a look at some short opportunities as well, because we're in this very mixed picture and the markets can go either way. So I wanted to present some short ideas, that because there are quite a few here that are starting to emerge here. And if we look at XLB, this is really where we see some rotation, in my opinion, out of some of the strongest sectors, which is materials, and perhaps into some of the weaker sectors like utilities. We continue to see a little bit of rotation into financials as well, but certainly a rotation into more of the defensive sectors like staples and utilities. And we're starting to see this outflow from XLB. And I wanted to bring out XLB because XLB is pretty much has made no progress here over the past month and a half. But while it does that, the momentum has been moving lower. And if you look at market breadth from accumulation distribution, also moving lower. This signals to me that perhaps this could be a temporary top here for materials as it struggles to get back above the $67 double top level here, and could potentially reverse back into the low 60s. Here is one that I'm paying attention to as a rotation out of these strong sectors into more defensive sectors. Now, the next one I wanted to take a look at is Tyson Foods. So many of you may have seen in the news of the chicken price fixing issues that Tyson faces, and many of the protein processors are currently facing. And you have this stock that is largely range bound between the $66, $67 level and this $56, $55 level here to the downside. Now, if we look at this particular trading range, what you have is a recent breakdown in accumulation distribution to the downside below this range. So we're starting to see more distribution for the stock, meaning investors are selling this particular stock. And I think this points to what could be a breakdown below this $56 level and a continuation lower, even into the high 40s. Low 40s as well, potentially as extended targets to the downside. So Tyson Foods, one of the really strong performance of the market prior to the coronavirus, but has really taken a strong move to the downside since then and has not been able to recover and is actually moving sideways and starting to trend a little lower here. So trending sideways on an absolute basis, but certainly trending lower on a relative basis compared to the markets, compared to its sector. And this is really where I see some further potential downside here for a weak name like Tyson Foods. Another name I want to point out too is ADP. This is one that I've been watching for quite some time now, but now I actually think is the right time to enter this because ADP has been largely range bound since the recovery of the coronavirus. And this is due to, in my opinion, the uncertainty around the shape of employment recovery. Employment recovery continues to surprise us to the upside, but ADP, every time we have strong employment numbers, did not really manage to rally off of those numbers. And what we have seen is that recently we had a pretty strong move from that 128 to the 152 level. And I think this was largely on hopes of a stimulus, of a sizable stimulus bill. But we've really seen some of those hopes start to fade here over the past couple of weeks, past couple of days. And that's really the weakness that we started to see here on ADP over the past week. So this looks very similar to the recent run up that we had here, rejection of the 200-day moving average, and then subsequent move to the downside. We've seen the same thing again, hopes on the recovery, rejection of the 200-day moving average, and a potential move to the downside is the one that I'm paying attention to here for ADP. So as payrolls, as we have a consistent number of roughly 30 million unemployed here in the US, and that number has not budged very much, and we actually saw continuous claims rise last week. This speaks to just the shape of the economic recovery in terms of from an employment perspective, and ADP processes a very large number of small businesses, payrolls, benefits, and is likely going to see some churn from these types of small businesses. And that's why looking at ADP, I'm looking for more of a short opportunity to fade some of the stimulus hopes, especially going into today. If we don't get a deal, it's less and less likely to see a deal before the end of the year. And that is what could drive some weakness here in the broader markets or the equity markets here over the next couple of weeks. So that's how I'm currently viewing the broader markets. Some of the major support levels I'm paying attention to, watch those levels. If we see a breakdown below those levels, this could bring some weakness here over the next couple of weeks going into that election. And then perhaps as a post-election, that is the catalyst that could spark the next possible rally here in the broader markets. So that's how I'm viewing those markets. I will update everyone here this Friday again, based on where we currently see markets play out here this week, but very important to pay attention to because the ramifications here are not only for equities, but also for fixed income as well. So with that I want to thank everyone for taking the time out here this morning to take a look at what we have to show you here today. I do want to remind everyone I am hosting an event here today for the NASDAQ 100 index. For those of you that are interested in learning how to trade the NASDAQ 100 index, from an index options perspective. So even if you trade SPX or RUT or VIX, if you trade index options, today's event is really designed to help you better understand how to leverage index options for your portfolio. You can sign up using the link I just posted into the chat window. It is a full day event. We have multiple speakers starting at 11 a.m. through 3 p.m. You can look at the agenda, maybe certain ones that you're more interested in, you might attend those. You don't necessarily have to attend all 4 hours. But I think the very, very important one for many of you to attend is that last one at 2:15 to 3 o'clock. We have both Steve Sosnick, the chief strategist from Interactive Brokers, and Michael Coe. Many of you know him as the co-host of Options Action. We've put together a fantastic panel between Steve and Michael to talk about liquidity. A lot of investors ask us all the time about liquidity, about measuring liquidity, how to enter your orders, and we put together a panel to discuss these opportunities from the perspective of a market maker. A lot of you guys have questions about market makers and how they work and how liquidity factors into it. So they're going to give you some insights into that. So I think very, very important, even if you're not trading index options, potentially view that particular session. So you can sign up using the link on the screen that I just posted, or I will post it into the chat window here as well for those of you that you can register and you'll get the recording afterwards, even if you can't attend. So please register, and I hope to see you guys here later this afternoon. Thank you so much. Have a great day, and I'll see you guys later this afternoon.